Even on a full year basis, despite the unprecedented environment, our performance has been resilient and we have ended the year on a strong note with revenues and PAT higher by 18.2% and 22.7% year-on-year respectively. From an operational standpoint, I am happy to share that all phases of our Dahej greenfield facility are now fully commissioned. This facility is a state-of-the-art automated unit bringing in economies of scale and improved efficiencies. The plant has a total installed capacity of 132,500 metric tons per annum, enhancing our total capacity by 2.1x to 252,500 metric tons per annum. We have seen a strong ramp-up in utilization levels from this facility in recent months, leading to healthy volumes, particularly in the HPPC segment. Going forward, a strong upcoming pipeline of new product launches should enable us to substantially ramp up utilization levels at this unit over the next 3 to 4 years. I would also like to share that our second R&D laboratory, Rossari Center of Excellence, which was fully operationalized last quarter, is tracking a healthy progress in line with internal expectations. We are seeing improved traction here and are working on several projects to introduce niche offerings with unique product value. On the whole, we have closed the year on a positive note. While we saw normalization in demand and consumption sentiments across all the 3 business segments, the environment has evolved now with the second wave of COVID-19 infections. As per the stipulated state guidelines, we are undertaking all necessary measures to ensure and maintain the highest standards of hygiene and social distancing norms at our plants and corporate office. Looking forward, we believe improving vaccination drives and limited lockdowns should restore normalcy sooner than later. Overall, we are confident that the stabilization of demand environment and improved consumption will lead to stronger and sustainable growth in the quarters ahead. To conclude, all our 3 businesses are strong growth drivers for us, and the outlook for each business remains positive in the medium to longer term. With this, I would like to conclude my address, and I now hand it over to Mr. Chari for his comments.
Thank you, Edward G. Namaste and very good evening to everyone. We have delivered a resilient performance the fiscal year 2021 despite unprecedented operating challenges due to the COVID-19 pandemic. On a full year basis, our HPPC segment delivered excellent performance led by accelerated momentum in hygiene products and antiviral portfolio sales. TSC and AHN segments, while were affected in the first half of 2021, saw gradual normalization in demand and volumes toward the later half of the fiscal. In Q4FY21, all our 3 business lines have reported improved performance on a year-to-year basis. We are also witnessing healthy traction in engagements with several customers from the FMCG, textile and AHN space. On the operational front, globally, our industry witnessed pricing and availability issues in key raw materials during the second half of the fiscal. This did impact our gross margins to a certain extent. However, given our raw material sourcing framework and cost management, we were able to manage the situation and deliver healthy EBITDA margins of 16.1% and 17.4% in Q4 and FY 2021 respectively. Going forward, we anticipate our EBITDA margins to remain within this range of 16 to 18%. Coming to some key developments, in March 2021, our Board of Directors approved the allotment of 30.12 lakh equity shares on a preferential basis with a floor price of Rs 996 per share. This aggregated to total funds of Rs 300 crores. The funds from this issue have strengthened our balance sheet profile and augmented the financial flexibility to address medium to long-term growth prospects. In the coming months, we propose to utilize the net proceeds to evaluate and invest in inorganic growth opportunities which are within our core chemistries. For us, good corporate governance practices are one of the pillars of long-term value creation. In sync with this approach, in March 2021, our board approved the company's dividend distribution policy. In line with the stated guidelines, I am happy to share that the board has recommended a dividend of rupees 0.50 per share. On the whole, we have reported healthy performance in FY 2021. As we look ahead in a stabilized macro environment, we foresee an array of growth opportunities across all our three segments. We believe we are well poised to capitalize on these prospects given our diversified range of product offerings, fungible and agile manufacturing establishments, and the ability to constantly innovate and launch diversified products for this growing customer base. We will continue to focus towards growing wallet share across the existing customer base while tapping new customer segments with an aim to consolidate our market position as a preferred supplier. Before we close, I would like to cover an important development on the management team side. The board has accepted the resignation tendered by Mr. Manikantan Vishwanathan, Group CFO, on account of personal reasons. Accordingly, this will come into effect from close of business hours on May 25, 2021. The board would like to thank him for his contribution to the company during his tenure, and we wish him well in his future endeavors. On that note, I would now request Manikantan ji to share a few words, following which Mansi ji will share perspectives of the financial performance for the quarter and year ended 31st March 2021.
Thank you, Chari sir. Good evening to everyone. I will just like to take the moment to share that I had a wonderful time experience working with the entire team of Rossari, especially with Edward sir, Chari sir, and the management team. I wish them continued success in all their future endeavors. I will also like to express my appreciation to all the board members of Rossari, our shareholders, and the entire analyst and investor community for their support, and hope to stay in touch with you all. I would now like to hand over to Mansi, who will share the financial performance of the company.
Thank you, Mani sir. Good evening, everyone. Let me provide you a brief overview of the financial performance for the quarter and year ended March 31, 2021. During the quarter, we have delivered a healthy performance driven by improved demand and traction across the HPPC business and normalization in demand from the TSC and AHN businesses. On a consolidated basis, revenues came in at 218.2 crore as against rupees 159.5 crore in Q4 FY20. Revenues from HPPC stood at 108.5 crore, contributing to 49.7% of total revenues, followed by TSC business at 87.9 crore, contributing 40.3%, and AHN at 21.8 crore, contributing 10% of total revenues. On the profitability front, EBITDA stood at rupees 35.2 crore as against 24 crore in Q4 FY20. EBITDA margin stood at healthy levels at 16.1% in Q4 FY21. PAT during the quarter stood at 22.2 crore as against 15.1 crore in Q4 FY20. On a full year basis, our total revenue from operations in FY21 stood at 709.3 crore, up by 18.2% on year-on-year basis. Revenues from HPPC stood at 399.3 crore, contributing to 56.3% of revenue, followed by TSC business at 251.6 crore, contributing to 35.5%, and AHN at 58.3 crore, contributing 8.2% of total revenues. On the profitability front, EBITDA stood at 123 crore as against 104.8 crore in FY20. EBITDA margins were healthy at 17.4%. Depreciation was higher at 22.8 crore owing to capitalization of the Greenfield facility at Dahej. We anticipate additional charge to be absorbed efficiently as the new facility starts contributing to performance going forward. Interest cost during the year stood at 3 crore. PAT during the year stood at 80 crore as against 65.2 crore in FY20. The FY21 PAT figure includes a gain of 2.3 crore on account of fair valuation of previously held equity interest in a joint venture in accordance with applicable accounting standards. Excluding this figure, normalized PAT stood at 77.7 crore in FY21. From a balance sheet perspective, cash and cash equivalents during the fiscal stood at 107.8 crore. Net cash flows from operating activities during the year stood healthy at 47.8 crore. On that note, I come to the end of our opening remarks and would request the moderator to open the forum for any operational and strategic-led questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ritesh Gupta from Kotak Securities. Please go ahead.
Hello, sir. Thanks for taking my question. So just two. One is that on the QIP that you did, on the preferential release that you did, what is the inorganic opportunities? I mean, if you could just highlight in terms of what kind of inorganic opportunities you are looking at, that would be helpful. And secondly, on the Dahej bit, now that you have doubled the capacities, I mean, any new product line that you're looking at, or you have said that you expect to utilize the entire volumes in 3 to 4 years' time. I mean, is there some capacity already tied up which can actually lead to this utilization kind of getting preponed?
Namaste. In line with what we have been telling in the past calls, we are looking at inorganic growth opportunities closely, and which are within our 4 chemistries, and the board has mandated a very tight boundaries. So we are still evaluating and would like to do it as soon as possible. And this entails a process, and as soon as the process is complete, we would come to the exchanges and to our investors and shareholders in sharing the good news. Regarding the Dahej plant, as we have told in the past, we'll use the complete capacity in the next 3 to 4 years, and we hold good this view at this moment also. We see a good traction of demand in the products which we have focused in the past few quarters.
No, so the question was that, I mean, are you nearing any inorganic opportunity, or this is just a capital raise which basically creates a war chest for the future acquisitions, or is it that you're already evaluating few opportunities and are probably in final stages of that acquisition?
We are closely evaluating, various inorganic growth opportunities. Because nothing is finalized, we cannot share any names or which stage it is. As soon as we are able to finalize this, we will come and share with all the shareholders and investors.
And just on the Dahej bit, I mean, I think the question that I was trying to ask is that when you look at 3 to 4 years, I mean, when you look at 3-4 years, is this new capacity kind of backed up by you already started seeing some new project and contract flows, or is it that you are looking for some new opportunities eventually which will come your way? I mean, is it more of a preemptive capex, or is it more of a a defined capex where you already have demand tied up? That's the only question I had.
Yeah, Mr. Gupta, basically at Silvassa in the last year, there was really a huge capacity constraint. So what we've done is we debottlenecked some product lines from Silvassa, and that has been taken to Dahej, and therefore Silvassa is able to breathe well now. Apart from that, our strategy at Rossari is to seed new businesses. So if you see, we've already seeded in the HPPC segment businesses like paints, paper, water treatment, ceramics, etc. So these businesses which we have seeded, now we will go aggressively to convert them into proper sales, and that's where we see an uptick in our capacity utilization at the edge.
Got it, sir. That's very helpful. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Good afternoon, Chariji and Edwardji, and thanks for the opportunity. Couple of questions from my side. First, more bit on the numbers. Just wanted to get the understanding on the decline of other expenses on a quarter-on-quarter basis and both YOY basis, given that our revenues have grown really strong, and that we have started the new facility. I thought the cost should have gone up, but the cost decline is quite steep. That's one. Number two, on the numbers on the gross margin side, completely appreciated the fact that the RMs are completely all over the places and difficult to predict. How are the trends now in as we speak now? Have they stabilized? Have they started coming down? And what's on the availability situation? And what raw material really impacted on the availability side, which hurt the growth for us on the HPP side, where we have seen a decline on a quarter-on-quarter basis? So this is my first question. I will come up with the other question after this. Thank you.
Sanjesh ji, very good evening. Regarding, I'll answer the gross margin question first. Every year around the Chinese Chinese New Year, there is, raw material prices going up, and this is for the past many years. But also we see more than higher inflation in many raw material prices in the last quarter. But now in this quarter we are seeing some products raw material prices going down. Some are still holding strong, but we expect the normalization to happen sooner than later. This is, and regarding the expenses, if you see our expenses, our transport expenses have gone down substantially. Now, there were many customers where we were supplying to them on delivered basis, and now we have shifted to ex-work basis. So that is the major reduction which you see in, other expenses. But if you, go into detail, you will see that expenses like the factory expenses, contract labor costs, traveling, sanitizing expenses have gone up, and expenses like traveling, seminar, conferences have gone down. So some of them, have gone up and some of them have gone down. But the major impact is because of the reduction in freight expenses, which does not affect the profitability because earlier it was part of the sales when we were giving, and then, we were booking the expenses down, and now the expenses are not being seen, but the sales also is seen lower.
Completely appreciated that, but a 20% decline quarter on quarter, because I think all other expenses have been stable from Q3 to Q4. Rather, it would have only gone up travel and all because things started normalizing in the month of 4. But a 20% quarter on quarter decline, you're telling is because of the freight cost. Is the freight such a large expense for us?
Yes, sir. So the freight cost has been the major cost, and followed by distribution and cost, exhibition, seminar cost. So these are the areas where it has gone down. So the freight expense itself is the major cost for decline.
I was talking more quarter on quarter basis. I think the exhibition and all were even in the last quarter, I think. So I'm looking at more quarter on quarter basis rather than a normalized basis, because the only cost we can see is what you're telling is the transportation cost, which are saying there is a change in the contract term where it's more of a factory delivery rather than a delivery at customer place. Is that the understanding right?
Yes, exactly right, Sanjay ji. And also what has happened is in line with the reduction in gross margins, wherever the commissions would go down because margins are lower. So selling and distribution costs also would go lower. We have controlled, the traveling cost. We could see that business is happening without, increasing seminars and this. So that also has helped us in lowering the cost.
Great. On the gross margin side, can we expect that from Q1 onwards, the things should look only better? I can understand you would have inventory and so forth. So maybe 1 or 2 quarters, but the trajectory should be going back to again that 36-37% of normalized margin. That would be a fair assumption?
Sanjay, we always have been giving a broad gross margin levels of 32 to 38%, which is very, which is historically what we have seen different on quarters. We look at gross margins on an annualized basis. So you should be looking at, the gross margins on an annualized basis, and we expect to be, in this range. Definitely we see, softening of prices in many raw materials.
That's a great news. Just one strategic question on a high-level basis. Again, sorry to hop on the inorganic growth. I'm not asking any particular company or what process we are. It's more on the philosophy of inorganic growth we are looking at. So what will drive us for an acquisition, or what is one thing we want to look at when we are considering an acquisition? Is there a product gap, technology gap, or an entry into entirely new category within the four chemistries what we are defining? That's number one. Number two is more on the ROC side, given the kind of benchmark valuation in chemicals which are hovering today anywhere between 30 to 58 PE multiple, and that multiples are well known in the market because of the benchmark valuations on the stock exchange. What drives us the inorganic growth opportunity? Because we haven't seen any large inorganic acquisition in chemical space for last 3-4 years, valuations being or a compatibility or many other factors. So what is the philosophy which is driving Rossari, which has such a large canvas to grow organically, to also look at inorganic growth as an opportunity?
Yeah, Sanjay, this is Edward here. So our board has given us very broad boundaries between which we can do acquisitions. Of course, the financial boundaries are well known. All our ratios have to be in order. Debt-free company, then ROC should be between 20 to 25%, etc., etc. So these are financial boundaries which are well known, and that is our philosophy within Rossari. Coming from the business point of view, what we are looking at is not to acquire any company which is in the same product line as ours. So we would like to look at newer product lines, newer customer base. We don't want the same customer base, so we will be looking at a newer customer base. Of course, again, within the four chemistries that we work in. So newer areas of operation also is something that we are looking at. When I say areas of operation, I mean geographical area. So a company which has a footprint in countries other than India are also interesting for us. And finally, what we are looking at is if we get newer technology. So whatever technology comes in, it could be used for augmenting our own formulation technology, etc. One other factor that we've been looking at is if any of these acquisition targets have products that we can use as backward integration. So backward integration products are also something that would give us an opportunity to reduce or improve margins from.
Just a last question from my side. I have taken too much of time, but I'm completely apologize for this. But just one last bit from my side. Now, given the way valuations are there for chemical, does it really make sense for us to go, say, backward integration? I can understand new product line, new customer base where you can drive the synergy benefits within the own businesses, but backward integration buying at, say, at 25, 30 PE multiple, does it really boost the benefit from an overall merged entity ROC basis? Does it really is a sound financial decision, do you think?
Mr. Sanjay, as you will see that the backward integration thing I said at the last, because that is not the priority. If that happens, it is an additional advantage to us. That's all. That's focus would be the broad boundaries that we said: technology, new product lines, new business, new customers, and improved geographical footprint.
Great, Edwardji, and thanks and being patient for answering all the questions, and best wishes for your future growth and the inorganic opportunity. Thank you.
Thank you.
Thank you. The next question is from the line of Swarnabh Mukherjee from Edelweiss. Please go ahead.
Thank you. Good afternoon, Edwardji, Sunilji. Hope all good at your end. Sir, 2-3 questions from my side. First of all, wanted to understand the impact of this raw material price inflation that has happened. Which of the three segments has been impacted the most because of this? If you could give any color on this.
Swarnabji, good evening. All is very well and hope the same with you. All the three segments have been affected, by the impact of RM price inflation.
Okay, so is it fair to understand that all of them have been, equally impacted? So kind of a uniform impact across segments.
Yes, we see inflation across different businesses and sub-businesses and subdivisions.
Okay. So, sir, just wanted to understand that in such a scenario, and given that there is a fungibility in your plants as well as on the raw material side across your three segments, what led to, given that the price impact was uniform across the segment, what led to a relatively higher margin business of HPPC seeing a volume impact as compared to the textile segment, which actually grew on a sequential basis as well?
Sonatji, as stated earlier, we had supply chain issues with certain raw materials for the HPPC division. But because the plant is fungible, we were able to use capacities to make products for other divisions. The raw material inflation is seen in various industries, other than even specialty chemicals in this. But this is the norm in every last quarter of the year. And so we believe, that this would soften and it will normalize in the coming months. We are looking at a facility which is fungible, and this is the biggest advantage we have at this moment.
Sure, got it. Sir, so I just wanted to understand a little bit more closely on your ability to pass on this raw material price. So I think last quarter, on a similar question, I think the response was that it happens in different sets of customers, like the ODM customers or contract manufacturers. You have a formula-based pricing for certain other products, which is done through mutual understanding. So first of all, the contractual products that are there, where there is a formula, any ballpark idea you can share on what proportion of it would be your sales coming to this?
Sonatji, as a practice, we are not able to give you, granular details on subdivisions in each division. But what you say is perfectly right. In ODM and formula-based pricing, everything is passed on a day-to-day basis. So if the raw material prices increase today, it will be passed on today itself. Regarding your RM prices increase, किसमें pass on कर सकते हैं? I will give you an example of a product called acetic acid. Now the acetic acid average price range in the last 10 years has been between 25 to 60 rupees. It went up to 130 rupees. So definitely, we do not have 400% gross margins. So wherever it is, we have been able to pass it on. Sometimes there is a small lag, but definitely we pass it on. With certain customers, we have long term. तो थोड़ा ऊपर नीचे होगा तो हम लोग संभाल लेते हैं. जहाँ कभी-कभी कम होता है तो भी हमारे को कम नहीं करना पड़ता है. जब भी बढ़ता है तो थोड़ा हम लोग संभाल लेते हैं. So it is a balance which is honed over last many years, keeping in mind customers' relationships. But also keeping in line that our EBITDA margins stand, in what we have given the guidance.
Sure, sir. I understand. So just to ensure that I understand the dynamics fully, so on a sequential basis, your revenues for HPPC was down by around 9%. Now, is it fair to assume that maybe across all product baskets, whether fully or maybe a little bit, you have been able to increase the prices? Does that mean that your volumes in this segment went down by more than 9%? Would that be a fair understanding, sir? And that is primarily because of some delay in procuring raw material.
Mainly, we had some loss in the products which were based on acrylic acid, but they go across the businesses which we have or subdivisions which we have. So the raw material prices have been there. but our volumes have been in line with the last financial year. So when we see volumes, year to year, there has not been, it has definitely increased because there has been increase in sales. But per kilo realization is something which is in line with the previous years.
Okay. Is it possible to share even at a blended basis what has been the volume growth this year? Even a rough number would do, sir.
As a practice, we have not been able, giving volume details in any earning calls.
Okay. Okay. I also just wanted your comments on the performance of your two subsidiaries, because I see that the number is going really well, growing really well. This quarter, I think the income in the statements have come to be around 17 crores from the two subsidiaries. So if you can throw a light on how these two are performing, both Buzil and personal care.
Certainly, the BRPL business has done well. We have about sales of about 53 crores in the last financial year. It has a substantial increase primarily because the home health and hygiene portfolio did very, very well. And we see, good traction in our industry also for this financial year. The Rossari personal care business also overachieved its budget. So we are very happy with the performance of both the subsidiaries.
Okay, great, sir. And just one last bookkeeping question to Mansi ji. Madam, what would be, as now everything has been fully commissioned, what would be the depreciation run rate going forward? If you can throw some color on that.
Depreciation for the full year, this year it was 22 crores approximately. We have capitalized 107 crores in the current year for Dahej. So we expect the same rate of depreciation to be continued.
Okay, so the quarterly run rate that we have seen in Q4 is that will continue?
What?
So, depreciation quarterly run rate that we have seen about 7.4 crores close to, that will be the run rate that is going to
continue. So next year it will be full year depreciation on the entire plant.
Sure, ma'am. Sure. Thank you all. I'll join back in the queue for further.
Thank you, Sarnaji.
Thank you.
Thank you. The next question is from the line of Nitin Gosar from Invesco. Please go ahead.
Hi, good afternoon, team. Two questions, sir. One is inorganic opportunity. Already the questions have been asked, but could you just allude further to it? At which stage of evaluation we are, or have we done any kind of due diligence for certain candidates which have been already as a part of our radar list?
Hi, Nitinji.
Hi, sir.
Yeah, we were all very sure that these questions would come for the inorganic opportunities. Unfortunately, we will not be able to share a lot more details, but I could give you an idea that it is not one or two companies that we are evaluating. There are more than one or two companies that we are evaluating. And definitely, as soon as something is finalized, we will get back to you.
Sure. Have you called out any kind of outer limit, if at all, for this inorganic opportunity to be concluded? Like 1 year, 2 year, any roadmap?
Yeah, for sure it is not going to be 1 and 2 years. It will be much earlier than that. However, there is from case to case basis, we have no bounds on what could be the opportunity that we look at.
Got it. So second question is pertaining to the EBITDA margin guidance. I believe we called out 17 to 18% kind of EBITDA margins going forward for midterm. But if I were to connect this with the commentary that you alluded earlier with regard to the R&D pipeline, which is looking rich when it comes to niche products, how should we corroborate this commentary versus the EBITDA margin guidance? Are we underplaying, or is it that the 17-18% is still the better way of looking at the EBITDA margin guidance going forward, despite the niche product pipeline that we may be looking at?
Nitinji, good evening, Chari here, and the EBITDA guidance we have given is 16 to 18% for our existing businesses. which we are very, very happy and, sure about it. Regarding, the niche products, which we R&D is developing, we will continue to launch, as in the previous years, but the R&D expense is going to increase. For example, our rent has increased, over the past years for R&D labs, and also we now have about 40 scientists working there, and previously it was, nearly half. So the expenses will increase in R&D also, and we also have some development expenses in going for bulk trials for our products. It is a need, in our divisions where in the businesses we work in, and these are part of the expenses. So we are happy to guide on the 16 to 18%, in spite of a lot of new products coming up.
Got it. So one more question. In a normal scenario, if there is a CFO resignation, we would have not gone ahead and asked you this question, but keeping in mind the tenure or the lifespan that the person would have spent with your organization, it's lesser than 1 year. So we are forced to ask you this question. The next CFO that we may be evaluating, is it going to be internal person or is going to be an external hiring?
Nitinji, Mansiji is the CFO of Rossari Biotech Limited, and she continues here. She's doing very well. And Manikantanji, we had requested to join based on the acquisition opportunities which are coming up. And Manikantanji had some own personal reasons. We wanted to do some business, and he had some opportunities, and we said yes, happily, from both sides.
Okay. Right, sir. Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Thanks for the opportunity and good afternoon, Edward sir and Chari sir. So the first question is on our R&D initiative. So you have mentioned just a bit about during your opening remarks. Can you delve a little bit deeper in terms of what are the projects we are working on? Probably what is the gestation period we are looking at, and when would those projects will be fructified in pilot trials and probably will be commercialized? Because now we also have the capacity at hand, and it's just a matter of time these projects become successful in pilot stages, we can commercialize them. Thank you.
Rohitji, as I mentioned previously in the call, that Rossari has a strategy of seeding different industries. So in this strategy, we have seeded paints, we have seeded paper, we have seeded water treatment, as well as we have seeded ceramic tiles business. And we had also seeded the cement business, chemicals for cement. Now, these are the 4-5 industries in which we have targeted new products and products where to make them more efficient kind of thing, or make them more effective. This is one part of the R&D's objective. The other two areas that we are looking at, one is the silicone areas, because the silicones are gaining both is in HPPC as well as in the textile area. So we have focused on doing some kind of a backward integration in silicone area, as well as there is one new product range that we are looking at in the textile business, which is the sizing area, which is the polyester resins. So these are some of the specifics that I can give you. But the 5 industries that I mentioned, a lot of work is going on in R&D in those 5 industries that we've already seeded.
And this is, we are talking from the newer R&D center which is set up at IIT Mumbai, right?
Yeah. Everything is now focused at IIT Mumbai. Our Silvassa facility also does some amount of formulations for home and personal care. But home and personal care, since it is a formulation, there more application-oriented things are being done. However, a lot of R&D is done in the other 5 seeded industries that we've done.
Yes, thank you. So the second question is in terms of exports market. So how is now it shaping up? I mean, probably things are more or less stabilizing across the board. So what is our strategy on this front, maybe for the next 2 to 3 years? Thank you.
रोहित जी नमस्ते, चारी बोल रहा हूँ. The exports market, in the first 2 quarters of the last financial year were very slow, and now in the last 2 quarters they have picked up, and we see normalizing of the export demand, and this year also the export should do very well. In spite of lag in the first 2 quarters in exports, we were able to reach nearly the previous years with a very small drop in exports. This year we definitely expect it to be better.
Right. So on the raw material front, I understand that BPCL's Kochi facility has started working on acrylic acid. So now how is our dependency from the domestic source and exports? And will it give any material benefit in terms of our gross margins for the next few quarters?
Rohit, I am very, very glad and delighted to share that the first invoice from the BPCL Kochi refinery for acrylic acid was made in the name of Rossari Biotech Limited. We had signed an MOU with them, for acrylic acid, and they honored their promise that the first invoice will be made in the name of Rossari Biotech. Their plant is still in teething, trials now, and still not stabilized. But going forward, we definitely foresee that there will be more competitive, and our dependence on imports would reduce further. So this is a good opportunity for us.
Fine. So just one last clarification, and congratulations on the first, consignment from BPCL Kochi. So again on the inorganic initiative. So effectively, the criteria that you have mentioned, it seems that from day one, this particular acquisition will be EPS accretive. Is that understanding correct? Thank you.
Yes.
Sure. Thanks a lot and best of luck, sir. Thank you.
Thank you, Rohit. Have a nice evening.
Thank you. The next question is from the line of Rohit Ohri from Progressive Shares. Please go ahead.
Hi, sir. Under this new initiative of Rossari 2.0 and the new businesses that you have already touched upon that you'll be seeding with the existing assets, sir, are you looking at any soft diversification, or are you looking at adding a fourth segment to the business?
Hello. Rohit ji, namaste. Diversification, जैसा Edward जी ने बताया, so we are looking at adding, backward integration into some raw materials like silicones, adding more, products in the textile, home and personal care, performance chemicals, and even animal nutrition. So there is a lot of areas which we are working on together in the performance chemicals area.
Okay. And sir, when you speak of niche products that are already in the pipeline of R&D, are you looking at or are you trying to roll out some products which will be under the name of Rossari as a proprietary product or a proprietary molecule as such?
Definitely, we focus on products with the Rossari brand name and with the Rossari proprietary technology to launch in the market.
How many such molecules would be there over the next 3 or 4 years, if you can share that?
Can you repeat the question? What next to 3 to 4 years, Rohit ji?
So the proprietary molecules which you are working or the R&D team is working on over the next 3 to 4 years, how many such molecules would be there?
As you've seen in the past, calls, we focus on the intelligent chemistry platform, and these are mostly formulations, value-added formulations,
okay,
which either make the products, sustainable for the customer, processing sustainable for the customer, reduces sustainable load, reduces, costing, or makes process efficient. For example, there is a process which is doing for 18 hours. If we can do in 16 hours, then it makes it better. So even though we make ingredients, we want to make it intelligent ingredients where we value add to the customer what he is buying from the competition.
Okay, sir. Thank you. Thanks a lot.
Welcome, Rohit.
Thank you. A reminder to all the participants, if you wish to ask a question, please press star and 1. The next question is from the line of Nav Bharadwaj from Anand Rathi. Please go ahead.
Good evening, sir. Thank you for the opportunity.
Sir, quick question on the usual inorganic opportunity. Perhaps most of the points have been touched upon. Is it fair to assume that the acquisition that we'll be doing, we'll be looking for some kind of similar gross asset turnovers as we've been enjoying in our current capacity, or should we expect it to be on the lower side?
Broadly, it should be in the similar ranges. Our focus is on high asset turnovers always.
All right. Great, sir. And a little bit on some bookkeeping questions. We've done growth of around 80% on our revenue. RMCs increased by 24%. But if we have a look at the working capital, receivables, they've markedly gone up. And even inventory, there's been inventory days up by 32%. And payables, if we adjust for the other financial liabilities, it's up more than 35%. Could you shed some light on that?
On the working capital side, Bharadwaj, if you see our March sales, it was nearing 80 crores basic, and including GST, it is 92 crores. So, we had about 137 crores of debtors, which is translating to 45 days. But because we do it on the annualized basis, it looks many high days. But broadly it is in line. And similarly, the purchases were higher in the month of March. The creditors would be looking higher. So we are comfortable. If you see our past 23 years, we have practically zero bad debt record. So we'll always be focused because of the problems in supply chain. We kept little higher inventory, but this, if you see quarter on quarter, it also has been. And now there we have the waste plants, so we have 2 plants where we need to keep inventory. This is how. But we are focused on a prudent working capital management, and that is a hallmark of the Rossari's way of doing business.
Also, is it fair to assume that going forward, like even on the inventory days, you're at 75 days versus around 57 previous year? So should this normalize in the coming year, or we should be expecting some, higher receivable and inventory days going forward as well?
We are comfortable with anything up to 60 days of debtors, with the previous, month sales or previous quarter average sales, and this is something which will always be there.
All right. And on the payables front, sir, if you could shed some more light.
It is similar, to the receivables. The payables would be always in line with the receivables and the payables.
Okay. Thank you so much, sir. All the best.
Welcome, Bharadwaj.
Thank you. The next question is from the line of Siddharth Mehta from Principal India. Please go ahead.
Yeah. Good afternoon to you, sir. Sir, in terms of raw materials that you have explained regarding the inflation or the pricing issue, sir, is the supply continue to be a constraint, because in Q3 we had some constraint as far as import of raw material was concerned?
The supply constraints are reducing compared to the previous quarter.
Okay. Sir, second, sir, what are the steps being taken to increase the EBITDA margin range? Is a new segment like paint, ceramic, water treatment will be one of the drivers? And in coming 3 years, what percentage of revenue will be coming from these new segments?
Siddharth ji, EBITDA margin guidance so 16 to 18% ही रहा है, तो अपने को same EBITDA margin ही we are focusing on. So the theory of seeding new businesses, working on good margin products, the focus on HPPC continues. So we would have more than 50% of HPPC business. But then milk and nutrition also is an area which we think could grow very well in this year. And the textile is a cash cow for the company. Does not require too much investments. Working capital is in control. Margins are in control. So all in all the 3 drivers are doing well, and we expect the 16 to 18% gross margins definitely to be achievable.
And so, what percentage of revenue will be coming from these new segments might be in FY23? So which is like paint, ceramic, and others.
Broadly, more than half would be HPPC, and then the rest would be divided between both of them.
Okay, so one can say 25% in that sense.
No, the AHN is less than 10% in the last year, so this year it may go up a little.
Okay, so all these new segments which you have spoken about, which is paint, ceramic and all.
Yeah, that comes under the performance chemicals in the HPPC segment, and that is one focus area for us always.
Okay, so what that percentage, sir, it will be in FY23 in terms of overall revenue contribution?
As I said, Siddharth's HPPC segment would be in the range of about 50%. So the performance chemicals is part of the HPPC segment. We do not have breakups which we give for confidentiality reason for sub divisions within the division.
Okay. And so what can be the capacity utilization of this new Dahej facility in this year, which is FY22?
We expect our business to grow over the past year as in the previous years. The industry looks good. We have now more than double the capacity which we did in the last year. So the capacity utilization would be definitely higher than in this year.
And what would be, sir, that number, if it is possible, on our increased base of 252?
So it will be, in the range of 40% and higher, and so we'd have adequate capacity for a spike in orders ready, for which we made the plant already.
Okay, so what you're saying that the 40% on the overall volume of 252 minimum.
So the age, would be nearly less than half of what capacity. So what we are seeing, Siddharthi, is the age is more efficient because there is more automation there, and the cost looks, very controllable in the age compared to Silvassa because manpower requirement is less in the age. So we have shifted a lot of products from Silvassa to Dahej because there was capacity constraint in Dahej. So some part of the Silvassa production has been shifted already, in there, and the new businesses which we get in the HPPC would be there, but the contract manufacturing business, the animal and nutrition business, and some part of the other HPPC and textile would continue in Silvassa.
Okay, so just again clarifying myself on this new capacity or aggregate capacity of 250,000 and just rounding it off. So you are saying around 40% would be the capacity utilization.
Of the Dahej capacity is 132,500 tons. We would like to exceed that 132,500 tons, 40% से 50% वहाँ we would like to use Siddharthi, but it depends on the products which come. Because it is fungible, जो भी जिधर भी orders आएगा, we are happy, but we would prefer to use the Dahej facility more if you have an option in any product.
Perfect, sir. That makes sense. And in case of Silvassa, whatever the capacity that we have, so that will be like operating at around 70%?
No, it will go lower, the Silvassa capacity, because a lot of products have been shifted there to the Dahej facility.
So I am speaking about the capacity utilization. Whatever the capacity
will go lower in Silvassa because there is a lot of products shifted to Dahej.
Okay, sir. Okay. Sir, can you also speak something on this animal health care, animal health and nutrition, which has done very well in this Q4? How is the momentum looking like?
Animals and nutrition, we are looking very good traction. The last quarter, as we had informed earlier, has performed very well, and we are looking at good traction in this year also.
Okay, sir. So, sir, best wishes for upcoming quarters. All the best, sir.
Thank you, Siddharthi. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
So thank you, all of you. I hope we have been able to answer all your questions satisfactorily. If you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and have a good day. Bye.
Thank you. On behalf of Rossari Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.